Hello and welcome to our beginner's guide to investing. Today, we'll be taking you through the basics of investing and providing you with valuable tips to help you get started on your investment journey. Step 1. Set clear financial goals. When it comes to investing, setting clear financial goals is essential. Take some time to determine what you're investing for: retirement, a down payment on a house, your child's education, or any other financial objective. Setting specific goals helps you stay focused and make better investment decisions. For example, if you're saving for retirement, calculate the amount you'll need and the time horizon you have until retirement. This will give you a target to work towards and enable you to choose the appropriate investment strategies. Having a clear understanding of your goals will also help you determine your risk tolerance and investment time horizon. Step 2. Educate yourself about investment options. To make informed investment decisions, it's crucial to educate yourself about different investment options. Let's explore some common options. Stocks represent ownership in a company and offer the potential for capital appreciation and dividends. You can buy individual stocks of specific companies or invest in diversified portfolios of stocks through mutual funds or exchange-traded funds, ETFs. When investing in stocks, it's important to research and analyze the companies you're interested in, considering factors such as their financial performance, competitive advantages, and industry trends. You can use financial statements, company news, and analyst reports to gather information and make informed investment decisions. Bonds are fixed income securities issued by governments or corporations. They provide regular interest payments and return of principal at maturity. Bonds are considered safer than stocks but offer lower potential returns. When investing in bonds, you need to assess factors such as the creditworthiness of the issuer, the bond's maturity, and the prevailing interest rates. Government bonds are generally considered less risky than corporate bonds, but they also offer lower yields. Understanding the different types of bonds and their associated risks will help you make appropriate investment choices. Mutual funds pool money from multiple investors to invest in a diversified portfolio of stocks, bonds, or both. They are managed by professional fund managers who make investment decisions on behalf of the investors. Mutual funds offer a convenient way to gain exposure to a variety of investments without having to select individual stocks or bonds. When choosing mutual funds, consider factors such as the fund's investment strategy, historical performance, fees, and the fund manager's track record. It's also important to evaluate the fund's risk level and compare it with your risk tolerance. Real estate investments involve buying properties for rental income or capital appreciation. Investing in real estate can provide both ongoing cash flow and potential long-term appreciation. When considering real estate investments, research the local market conditions, rental demand, and property prices. Evaluate factors such as location, property type, rental potential, and the costs associated with property management. You can invest directly in properties or consider real estate investment trusts, REITs, that allow you to invest in real estate through publicly traded companies. REITs provide liquidity and diversification within the real estate sector. Exchange-traded funds ETFs are similar to mutual funds but trade on stock exchanges like individual stocks. They provide diversification and are often designed to track specific market indexes. ETFs offer flexibility in terms of buying and selling shares throughout the trading day. When investing in ETFs, consider the expense ratio, tracking error, how closely the ETF matches the index it aims to replicate, and the liquidity of the ETF. Look for ETFs that align with your investment goals and have a track record of closely tracking their respective indexes. By understanding these investment options, their potential returns, associated risks, and how they fit into your overall investment strategy, you can make better investment choices that align with your goals and risk tolerance. Step 3. Build an emergency fund. Before you start investing, it's important to have an emergency fund. This fund should cover at least 3 to 6 months' worth of living expenses. It acts as a safety net, ensuring that unexpected expenses or income disruptions won't force you to liquidate your investments prematurely. Having an emergency fund provides financial security and peace of mind, allowing you to stay focused on your long-term investment goals. To build an emergency fund, evaluate your monthly expenses and aim to save a portion of your income until you reach your desired fund size. Keep this fund in a separate high-yield savings account or a money market fund for easy access in case of emergencies. Step 4. Diversify your portfolio. Diversification is a key risk management strategy in investing. Instead of putting all your eggs in one basket, spread your investments across different asset classes, sectors, and geographical locations. This helps reduce the impact of any single investment's performance on your overall portfolio. For instance, if you invest solely in technology stocks and the tech sector experiences a downturn, your portfolio could suffer significant losses. By diversifying into other sectors such as healthcare, consumer goods, and real estate, you can mitigate risk and potentially enhance returns. To achieve diversification, consider investing in a mix of stocks, bonds, real estate, and other asset classes. You can also diversify within each asset class by investing in different industries and regions. Mutual funds and ETFs can be useful tools for diversification as they provide access to a diversified portfolio of investments within a single investment vehicle. However, it's important to note that diversification does not guarantee a profit or protect against losses in a declining market. It is a risk management strategy that aims to reduce the impact of individual investment performance on your overall portfolio. Step 5. Choose the right investment account. When choosing an investment account, consider factors such as taxes, fees, and accessibility. Here are some common types of investment accounts. Individual brokerage accounts offer flexibility and accessibility. You can open an account with a brokerage firm and buy or sell investments as per your discretion. However, gains from investments in brokerage accounts may be subject to capital gains taxes. It's important to understand the tax implications and consult with a tax professional to optimize your tax efficiency. Retirement accounts offer tax advantages for long-term savings. Some common types include individual retirement accounts, IRAs, and employer-sponsored plans like 401(k)s or 403(b)(s). Contributions to traditional IRAs or employer-sponsored plans may be tax-deductible, reducing your taxable income in the year of contribution. In these accounts, investments grow tax-deferred until withdrawal. Roth IRAs, on the other hand, are funded with after-tax dollars, but qualified withdrawals in retirement are tax-free. Consider your tax situation and long-term retirement goals when choosing the right retirement account for your investments. Education savings accounts like 529 plans offer tax benefits for funding education expenses. Contributions to these accounts may be tax-deductible in certain states, and investment gains grow tax-free. When used for qualified education expenses, withdrawals from 529 plans are also tax-free. These accounts provide a tax-efficient way to save for higher education costs for yourself, your children, or other beneficiaries. Research the available 529 plans in your state or consider plans from other states that offer attractive benefits. Evaluate your options and choose the account type that best aligns with your goals, risk tolerance, and tax considerations. Step 6. Start with index funds or ETFs. For beginners, a great way to start investing is through index funds or ETFs. These funds allow you to gain instant diversification by tracking a specific market index, such as the S&P 500 or the Nasdaq. They provide exposure to a broad range of companies and are passively managed, meaning they aim to replicate the index's performance rather than actively selecting individual stocks. Index funds and ETFs are typically low cost and offer an easy entry point for beginners. By investing in index funds or ETFs, you're essentially investing in the overall performance of the market or a specific segment of the market. This strategy eliminates the need for in-depth research and stock picking, making it ideal for beginners who are still learning the ropes of investing. Plus, the low fees associated with index funds and ETFs allow you to keep more of your investment returns. For example, if you're interested in investing in the S&P 500, you can choose an S&P 500 index fund or ETF that closely tracks the index's performance. By investing in this fund, you'll own a proportionate share of the underlying companies in the S&P 500, providing you with broad market exposure. Step 7. Set up regular contributions. Investing is a long-term game, so it's important to contribute regularly to your investment account. Set up a systematic investment plan where you contribute a fixed amount on a monthly or quarterly basis. This strategy, known as dollar-cost averaging, allows you to buy more shares when prices are low and fewer shares when prices are high. It smooths out market volatility and takes advantage of price fluctuations. Automate your contributions to make investing a habit and stay disciplined in your approach. For instance, You can set up an automatic transfer from your bank account to your investment account every month. This way, you'll be consistently adding to your investments, regardless of market conditions. Over time, this disciplined approach to investing can help you build wealth and take advantage of the power of compounding. Step 8. Monitor and rebalance your portfolio. Regularly reviewing and rebalancing your portfolio is essential. Over time, the performance of different assets within your portfolio may vary, causing your asset allocation to deviate from your target. Rebalancing involves selling some investments and buying others to bring your portfolio back in line with your desired asset allocation. This ensures that you maintain your desired risk level and stay on track with your investment goals. Review your portfolio at least once a year or whenever there are significant changes in your financial situation. Let's say your target asset allocation is 60% stocks and 40% bonds. Over time, if the stock market performs well and the value of your stocks increases, your allocation to stocks may exceed 60%. To rebalance, you would sell some stocks and buy more bonds to realign your portfolio with the target allocation. This disciplined approach helps you buy low and sell high, and it ensures that you don't become overly exposed to a particular asset class. Step 9. Stay informed and seek professional advice. Stay informed about the markets and economic trends. Follow reputable financial news sources, read books on investing, and stay up to date with economic indicators. However, it's equally important to avoid making impulsive decisions based on short-term market fluctuations. Maintain a long-term perspective, and remember that investing is a journey. If you're unsure about investing or need guidance, don't hesitate to seek professional advice. A qualified financial advisor can provide personalized recommendations based on your circumstances and goals. For example, if you're approaching retirement and have specific income needs, a financial advisor can help you create a retirement income strategy that considers your investment portfolio, social security benefits, and other income sources. Remember, investing is a lifelong learning process. Stay curious, continue to educate yourself, and adapt your investment strategy as your financial situation evolves. Thank you for watching.